Embedded leverage is crucial for investors who do not have access to low-cost leverage, which is stable and cheap financing. This need for embedded leverage arises from an investor's inability to use enough outright leverage to get the market exposures they would like. For example, most individual investors and pension funds may not be able to use any outright leverage. Most banks face regulatory capital constraints, and hedge funds must satisfy their tedious margin requirements. There are various options for an investor to get outright leverage and gain substantial market exposure by utilizing financial instruments that embed leverage, like option contracts and leveraged ETFs. These financial instruments are customized to provide embedded leverage in most cases. I believe strongly that embedded leverage is correlated with lower required returns. When I look at the overall return of asset classes with embedded leverage, it shows that these asset classes to offer lower risk-adjusted returns. Across the spectrum, financial instruments that offer embedded leverage like equity options, index options, ETFs, and other securities with more embedded leverage offer lower risk-adjusted returns. When looking at each asset class, I strongly suggest utilizing a portfolio that contains a long, low embedded leverage securities and short, high embedded leverage securities, which in most cases is considered neutral to each underlying security and is constructed to be a market-neutral portfolio. In general, Berkshire Hathaway's overall stock return can be decomposed in the performance of publicly traded companies that it primarily owns and the performance of the privately held company that it owns, and the amount of leverage it uses. It is evident that the performance of the publicly traded companies is a measure of Warren Buffett's stock-picking ability, but the performance of the wholly owned companies shows his successful ability as a manager. I cannot simply observe the value and performance of Buffett's private companies, but I can observe them based on past performance. First, I can infer that the market value of the wholly private companies as the residual given that I can observe the value of the total assets, the value of the publicly traded stocks, and the cash. It is shown that Berkshire Hathaway approximately owns 2/3 private companies and 1/3 being invested in publicly traded equities. Berkshire Hathaway has a steady increasingly reliance on private companies throughout the years due to the stability and strong cash flow. It is evident that both wholly owned private companies and publicly traded stocks both perform relatively well. Warren Buffett's public and private portfolios have both exceeded the overall stock market in terms of excess return, risk, and Sharpe ratio. It shows that the publicly traded stocks both perform relatively well. Warren Buffett's public and private portfolios have both exceeded the overall stock market in terms of access, return, risk, and Sharpe ratio. It shows that the public stocks have a higher Sharpe ratio than the privately held companies, which shows that Buffett's skill comes mostly from his ability to pick certain stocks and not from his ability to add value as a manager. Berkshire Hathaway's overall stock market returns exceeds both the private company and public stock portfolio comparably. This shows that Berkshire Hathaway is not only subjected to a weighted average of the publicly traded equities and the private company components, but has another component, which is the use of leverage that magnifies returns. It has also shown that Berkshire Hathaway's overall Sharpe ratio is higher compared to the publicly traded equities and private company components. It shows the benefits of diversification by the benefits of time-varying leverage. In my portfolio, I stick to buying safe and low beta stocks, while staying away from risky and high beta stocks. Also, in my portfolio, I prefer to buy high-quality companies, which are companies that are profitable, growing, and safe. Berkshire Hathaway has shown throughout time that it has emphasis on buying safe and high-quality stocks. One of the main drivers for Buffett's and Berkshire Hathaway's success is the fact that he buys safe, high-quality, and value stocks. Warren Buffett is known as the ultimate value investor, but he sticks to a sound strategy of focusing on safe and high-quality stocks, which is important to his success. It's important to note that the importance of leveraging low beta and high-quality stocks for the person known as the ultimate value investor. Berkshire Hathaway's stock return does reflect the incurred transaction costs and possibly additional taxes, which makes his success even more impressive. Due to Berkshire Hathaway's modest turnover, transaction costs were luckily small initially. As Berkshire Hathaway grew, his transaction costs continued to increase, and this could potentially account for some of Berkshire Hathaway's diminishing returns over time. Furthermore, Berkshire Hathaway has continued to invest increasingly in larger stocks. To sum up, if you as an investor applied leverage to a portfolio of safe, high-quality, and value stocks,